Community Reinvestment Act requirement. A few words about Community Reinvestment Act that's been with us for 25 years. A major regulatory shift that has had enormous effects. If we look at, and here I'll talk about a failure and a success story, as to what happened post-riots in Los Angeles. Those of you guys remember the Rebuild Los Angeles, Rebuild LA? Which really does, I think, good analytically, but a real failure in terms of outcomes. And one of the real failures that was part of the Rebuild LA experiment was, and it was a tragic one, was the Community Development Bank, which you always knew you were in trouble when you get the card. It said the Community Development Bank, and then it would say not a bank in parentheses. So they were restricted. They were essentially capitalized by HUD money that came in, which had lots of strings attached. It was geographically restricted by zip codes. It had all sorts of restrictions upon it. It was that if you were an entrepreneur in that area, a town in South LA, where the riots were most present, and you wanted to invest in Santa Monica, you couldn't do it, right? Or if you were somebody outside of that zip code and you wanted to invest in it, but you weren't from that area, you couldn't do it. And if you hadn't been turned down 3 times by a bank, you couldn't do it. So this thing was rigged to fail. And so I think that's a very good example of the learning from failure, and to try to what I think came out of that eventually was under Mayor Reardon was developing the Genesis Funds, which was a 501c3 set up as a nonprofit, separated from government, underneath of which there have been 3 funds formed: a mezzanine fund at about $85 million, a private equity fund at around 55, and an affordable housing fund at I think a little over 100. So that should add up to around, I missed a digit there somewhere. It adds up to about $320 million in equity funds that's leveraged over $1 billion of investment in the hardest hardest hit LMI areas of Los Angeles. Again, it was this blend of a business model with a nonprofit, which has been successful relative to the failure of the Community Development Bank. Angel investor is a very important role. I'm running out of time. This issue of revenue royalties, I think that's been present in a number of cases. A mezzanine fund structure which blends investors that seek different levels of return. I've talked about that idea and how that could work. There's a structure of that. And then I just run through, I'm on the advisory board of something that we call Wall Street Without Walls, which Greg Stanton started. Greg's a really interesting guy. He was a junk bond trader for Mike, and a really incredible personality, and got hit really hard, not financially, but running around the reservoir in Central Park. He had a heart attack, and then he was running around, got recovered, running around again, and got another heart attack. I mean, he tells the story the same way I'm telling it. And he really figured God was talking to him. I mean, literally. So what else does he have to say? So he ceased being a bond trader and decided to apply those skills of financial innovation to nonprofits. And these are the types of examples that Wall Street Without Walls, the notion being an obvious knockoff of Doctors Without Borders, but the notion that people that most of the population don't think that could get through the metal detectors at the airport because of their heart, in terms out of the finance industry, might actually have something to contribute to that they're hard-hearted, obviously. But the idea that financial innovation and finance professionals can operate, I think, in the nonprofit world. And there were some great examples that Wall Street Without Walls has worked on here, and I just review a few here that basically whether it's packaging LMI mortgages, to working on Greystone Bakeries, which was a social business venture, to C Corp, to the Brooklyn Navy Yard. Are we up to that yet? Yeah. For an insider employer, for a venture fund for low, moderate income businesses in Maine, to low income housing, to Acción. All of these are I think, really useful examples for us to talk about in the rest of the day. So I think the points to remember is that the complexity of capital structure, capital structure really does matter. Then that there's no one capital structure that fits all nonprofit enterprises, and that perhaps opening the issue from just a venture capital framework to its application of the other layers of the capital structure is an important one. And to look at the ways that innovations that are developed can be leveraged by nonprofits, I think that's our issue and our challenge here today. So I'm sorry for running over, but any questions? Tried to pack a lot in. Any questions? Yes.
Are any of these alternative vehicles, do any of them have, and I'm sure they do, but I'm not as familiar with them, sorry. Any of the alternative vehicles, do any of them have quite a bit of, is there any tax incentives based into them or baked into them that have or haven't or will or could potentially kind of enable some of that to occur?
Well, they could be structured into them, in the sense if you, to the extent that you can issue 501c3 tax-exempt bonds, that's a huge tax incentive, I would think. And the CRA incentive for financial institutions is an enormous one. In the change in the 93 CRA allowed you that if you were a bank and you weren't complying with your CRA requirement, that you could invest in instruments. Our big beef is there haven't been enough instruments out there for people to invest in, so the banks still keep getting beat over the head for not making sufficient investments in LMIs, but out of the market, in terms go back to the question of deal flow, we're not generating enough instruments or enough things for them to invest in. And I think some of the types of innovations, if they were applied, would have CRA. That's what really drove the Genesis funds, was all the investors are banks. There's very little pension investment, oddly enough, and it was CRA driven. Yes.
You spoke of the dramatic change that the securitization of debt instruments, mortgages made. Has any of that been done with the micro-lending, within the micro-lending industry, or for micro-lending instruments, securitization?
First one last year, Blue Orchard was done, and that was the first one.
40 million. There's a round
40
right
million.
now. They're looking for capital. The second round is being structured right now, so if you're interested, and the attractive thing about the structure, the first round was done over the summer, and there's a second round that they're putting together right now. They are looking for investors, and it's structured so that the majority of the investment is a senior investment that actually has an OPIC credit enhancement, so that in fact it's carrying U.S. government risk. So it's a rather sound investment. There clearly as well, there's like 4 levels of sub-debt tranches that they're also looking for investors to participate in, to put the whole thing together.
What is the size level of these offers?
The first transaction was $40 million, and I believe the second one's expected to be about the same size, more or less the same framework.
Thanks, Brian.
Yes, I think Peter had it. Okay.
I was just curious about the Pups for Peace story that you told at the beginning, and it wasn't clear to me whether your exit strategy was simply getting rid of or moving that into the private sector, whether there was a repatriation of capital to you, or whether there's an ongoing
I'm sorry
revenue.
I didn't make that clear. No, it really isn't a complete exit. It's just to create a for-profit flow of income back to the nonprofit purpose. Okay. So we do get out of that contract that was just one. We're actually able to to fund about 35 to 40% of our operating needs.
Thanks.
And we don't have to go to donors for that. So.
Yeah.
Thank you, Glenn.
Yeah. Thank you. Oh yeah.